Namaste, Sat Sri Akal and Adab. Welcome back to another episode of One on One with Mr. Bond. Today we have a very interesting guest who is not only a business colleague for all of us, but also a very dear friend of mine. He is Executive Director of Motilal Oswal and the Chief Business Officer, Akhil Chaturvedi. What we are going to discuss today is the stupendous start which the fund house had in terms of their equity performances. And they're unapologetic that they are only going to be concentrating on equity as an asset class. And that's the reason when they went into a lull phase, they had to do a lot of introspection. And then how did they bounce back and how they have come back on top practically in all the categories of equities funds is what we are going to discuss today. So a lot of discussion will happen on the processes, the mistakes, the course correction, and all that will be discussed with Akhil. And of course, we will talk about the elephant in the room in terms of the valuations of the markets and where do they see as a fund house where the markets are headed. Welcome, Akhil.
Thank you, Sunil. Always a pleasure talking to you. Thank you so much.
Always a pleasure. And always a pleasure talking to different fund managers from your AMC also and getting a lot of different perspectives of the market. So,
Yeah,
Akhil,
for a change, you bring the sales guy.
Yeah. No, but yours is overall. It's not just the sales. You're the chief business officer. You're the executive director. You've seen the AMC grow from very small levels to the current levels. I'm sure you were one of the first employees of the AMC.
Not the first employee, but yeah, the one of the early ones.
One of the early ones, yes. So you've seen the journey. So nobody better than you in terms of discussing what we are going to discuss today.
No, absolutely.
You started with a big bang. In 2014, you came up with your Flexi Cap, which was called, I think, if I'm
it was most focused 35 fund and then
most focused 35 or most focused 35 fund.
Yeah.
So that is now rechristened as Flexi Cap Fund. And it came, as in the music parlance, it was on the playlist of practically every investor and every mutual fund distributor. So what went right for you was that the QGLP, you are the only fund house who has spoken about their investment philosophy from day one.
Right. Yeah, Sunil. So yeah, it's like a complete full cycle for me, honestly. So when I started with AMC, obviously these were the early products, the Flexi Cap Fund, erstwhile known as Focus 35, F35, M35. Different people used to call it different names, but all taken in the right stride. So at that point of time, obviously, if you see the market cycle was a bit somber. We were coming out of a difficult period somewhere in 2014. And it was that year when we saw the NDA government coming in, actually, and all the funds started in markets only after 2014. Prior to that, the 10 years were really bad years, right? Now, in a economic cycle, which is more, in a slow growth mode, earnings momentum was practically not there, absolutely, right? So in difficult market cycles, typically high quality companies are the ones who tend to do better than the rest of the other businesses. So if you see that period between 2018 to 2013, the EPS growth of the Nifty 50 used to be about 5% or 6%. Whereas the EPS growth for high quality companies typically coming from FMCG, pharmaceutical, consumer durable, banking, financial, these are considered to be high quality sectors. There we were seeing earnings growth of 12%, 13%. And clearly at that point of time, those were the sectors, and within those sectors, those businesses were outperforming the broader market. Now, given our philosophy of high quality or QGLP, as you rightly mentioned, those were the names which were very comfortable to us, and a large part of our portfolios typically used to be allocated towards the quality side of the businesses, and that did extremely well between 2013 and 2018. We really didn't have to do any we didn't have to do any changes because we had the quality on our side, and earnings growth momentum was also in these sectors, and largely all the businesses we had were within these same sectors, and everything was doing well. We used to follow the buy and hold principles. So you were holding good companies with good earnings growth, bought at good levels, and we got the advantage of the re-rating of a lot of businesses businesses out here, and that's how the fund did extremely well at that point of time, top quartile, literally for 5 years in a row. And from I think 75-80 crores NFO collection, we made a top of about 13,500 crores in 2018. So that
Wow.
was the first 5 year journey. We were just invested at the in the right sectors, in the right businesses at that point of time, what was working.
No, I agree. But having said that, you said the earnings growth was 5 or 6% during that period. But your scheme actually delivered almost 22% from 2014 since launched till 2018 December. So that was a
Exactly.
stupendous, and you were the number one performer amongst all the flexi cap schemes. So you
Exactly.
done something beyond right.
Yeah, exactly. So, I mean, the sector selection was right. Within that, we got the right businesses. For example, we got, I can name many companies where we saw a huge outperformance over the market performance, whether it was
Multi-baggers.
Britannia Industries, or whether it was Ajanta Pharma at that point of time, whether it was Eicher Motors, Bosch, HDFC Bank, and these are all the bestest of the best businesses you can talk about. And these businesses were getting re-rated at that point of time. So we got the advantage of the earnings growth plus the PE re-rating, and that's therefore the outperformance was looking so great, so good at that patch.
So tell me now, post that, all of a sudden, just around the COVID levels, and so pre-COVID to during the COVID period, and a little bit of extension over the COVID period also, all of a sudden you came at the bottom of the charts, especially in flexi cap, mid cap, where you were the top performer during this period of 4 to 5 years, from 2014 onwards. From 2009, 19 Jan to about 2021, all of a sudden you dropped like you went into the valley, so to say. So
Yeah.
what went wrong, and what are the mistakes which in hindsight you could have avoided?
So two things happened from our own investing perspective. I think clearly. We used to follow buy and hold, buy right, sit tight at that point of time, and uh, I think towards 2017, 2018, I think these businesses became little pricey in terms of valuations. And when the downturn came in 2018, when we had seen that the long-term capital gain was introduced, ILFS crisis happened, IBC got implemented, a whole bunch. Right up till 2018, every 3 months, 6 months, you were seeing some or the other speed breaker. So the economy itself started to slow down. Like we were growing pre 2018, economic growth used to be at 6.5%. Pre COVID, we came down to 3.9%. So these businesses which were trading at extreme high valuations, post 2018 started to see slowdown in their earnings growth, and therefore the P multiples started to get derated very sharply. Right. So before we could actually make any changes or move, we already started to see very sharp corrections on some of the same names. So we got the advantage, 5 year advantage of re-rating, and we got some disadvantage on the de-rating side also. Simultaneously, what started to happen in the market is that the market started to get very broad based, more specifically after COVID. uh, like I said earlier, it was all the momentum was restricted to the quality side of the business, which became very, very expensive. Therefore, they started to underperform. And post COVID, uh, a lot of other businesses, whether you talk about Reliance Industries, out of nowhere, it became a multi bagger. All of a sudden, for 1 year straight, you saw a huge rally on the chemical side, on the metal side. Now you're looking at infrastructure, digital companies, power, or everything started to
No, no.
deliver.
So one side of the story is that some of the sectors where you were not invested started doing exceedingly well, but some of the sectors which you had invested, like auto ancillary,
Which was
finance,
underperforming. So
BFSI, etc., they were not supposed to do well during COVID period. So you were not nimble-footed enough for you to change the sector allocation because of your buy and hold strategy.
No, so it's not about being nimble-footed. We could see that our performances are slipping down. So we had already started to, kind of scratch our head and think about what went right, what went wrong, and all that introspection was going on in any case, right? And then one thing I think we heard from the market, from our distribution partners and our investors, is that eventually they are looking at a lot more consistency of performance than actually, bet on the
Spurts
top
of performance and then
funds with
going down.
volatile returns. I think we took that feedback very, very seriously, that eventually the market is expecting returns and consistency of returns. So
Correct.
we kept that in the center stage, and for that we had to move away from the stringent buy and hold philosophy to a more active philosophy. We had to create capability to understand a lot more sectors, a lot more businesses. So we started to invest in our investment team, whether getting the right fund managers, getting more and more analysts, getting the whole risk management team in place to ensure that if at all there are any risks within the investment team or the
So
investment
we'll come to that in a bit. But tell me, what was the within your team, because you're part of the sales team. There must have been it must have been a moral destruction kind of a thing for the sales team when the schemes are not performing and they're trying to go and sell it to the investors and the mutual fund distributors. How did you bring up their morale, or how did you manage to stay afloat during that period? And what was were there any redemption pressures because of the underperformance? How did you overcome those
so
challenges?
so whatever you've spoken, everything happened, right? So it's one phase which no client facing personal person would want to actually go through. Fortunately, in my case, I've spent now 25 years. Then maybe 5 years back, it was about 17, 18 years. But I worked in the industry for over 2 decades now. So obviously, been through all these ups and downs and all the cycles of AMC. There are good times, there are bad times. So that really did not put my morale down. Yes, obviously you don't like it when investors have put a lot of money with you, a lot of trust, and then their portfolios are underperforming. Calls come, you need to explain to them. uh, the only thing I think I try to maintain in our communication internally with my sales team and externally with our investors and distributors was that we are working on making the right changes to eventually, come back in line in terms of performance, and then ensure that we perform more consistently than before. I think our portfolios and the portfolio changes were had already started to happen. So a lot more communication, a lot more engagement we did with the market to give them the confidence. Having said so, obviously, it was a slightly elongated, kind of a bear market for us. So it went on for
Almost
almost
2 year
three and a half,
plus?
almost
Almost
three
two
years,
years plus?
almost 3 years.
3 years.
We lost several thousands of crores of assets. Fortunately, the market saved us, so we did not see dip in the AUM, but obviously net sales was negative, and that's a tough environment to be in. I think one thing what really saved us or kept the momentum up for us was the whole growth of the alternate investment fund category, right? So there is where we did couple of new ideations, new launches, a couple of distributors supported, so we could make up for some losses which was happening in terms of redemptions on the mutual fund side into purchases on the AIF side. But it was fun, because honestly, for me, what I've learned over last so many years is that I think in bad times you get really strong. In bad times you get more intelligent. In bad times you get more knowledgeable. In bad times you can
And
communicate
that
better.
time you start listening to people.
You listen to people. So I think it's a phase everybody should go through.
Correct.
Couple of times to just get better.
Yeah,
And
yeah.
remain humble.
So let's talk about the course correction which you did. Of course, one was the management side. You did some changes on the fund management side, the investment committee, and some of the things which you did was winners trim, overvaluation, laggards, double or quit, and exclusion mindfulness. So if you can just throw some light on these three aspects which you actually did and which benefited in terms of turning around the performance.
Yes, so I'll break this into three parts: people
Yeah,
level changes, process level changes, policy level changes. In
sure.
terms of people level changes, we were really very fortunate to get one of the bestest of the investment minds. Naveen Agarwal, who was our group managing director, he came into asset management as a MD and CEO. I think his insights and his involvement in the investment team actually boosted the morale of the investment team. I think he could fathom all that had to change within the investment team and at the policy philosophy level. So we started to work on that, and along with that, I think the other thing good which happened was about 2 years back we got a very experienced gentleman, Pratik Agarwal. at that point of time to head our investment strategy. Him with his 30 years of experience and more specifically his over a decade experience with ASK, I think really brought a lot of maturity, positivity in the within the team. So that those were some of the changes at the top level. Earlier it was only Ramdev Agarwal. Now with Ramdev, you had Naveen, you had Pratik, like three of them
Pratik.
actually became really the Tridevs of our
So
investment
they
committee.
actually were three Agarwals.
And three Agarwals not related to each other, but yes, they
Amazing. What a coincidence.
there are two Agrawals and one Agarwal. So,
Agarwal.
so
Yeah, yeah. A
but
slight difference in the spellings.
yes, so I think that all three of them put together, Ramdoji with 45 years of equity experience, Naveen with 30 years, and Pratik 30 years. You had good 130 years of very strong people with strong experiences who had lived through all kind of cycles. Then within that, I think we started to work around our fund managers. Fortunately at MO, we have a very large, very, very large pool of talent in terms of analysts, senior analysts from our institution equities and private equity, etc. So we got a couple of our senior analysts to join the AMC, and then they actually did well, and they grew to become fund managers. Niket Shah being one of them today, is a popular name in our industry. He's also been elevated as a CIO, but he was an analyst, but the best mid cap analyst. He was working.
Amazing, amazing person. I've interacted and interviewed him many times.
So great guy, done tremendously well at AMC, but he has grown through the journey, right? Over a decade and a half in this business. Then Atul Mehra, again Vaibhav Agarwal. So all of these, most of the guys are all in-house. We just had to kind of rejig the whole team and give right managers the right
It
product.
is amazing, what you just mentioned is really unique, which we are hearing right now for the first time, that every fund manager who you have now managing different funds of your AMC are all grown within the AMC. You've not
Absolutely.
hired people from outside so far, is
Absolutely.
what I'm hearing you say.
So you look at my mutual fund side, Niket Shah, 15 years with MO Group. He was
Wow,
earlier with institution equities, now with AMC, now become a CIO of the mutual fund business.
correct.
We have Atul Mehra, over a decade with MO, again with institution equities, then come to AMC. One of the best managers on my alternate side. Then we moved him in on the mutual fund side to manage the large cap fund. Santosh Singh, again, he's been here for over 4 years now. He was heading the research. We gave him to manage funds. So the focus fund and the balance advantage fund is managed by him. Right. Just one guy we bought from outside was Ajay Khandelwal. Again, comes with a great experience. So he's managing the small cap side. On the alternate side, I think all of them are. So there again, we have only one new person. So Rakesh Tarve, again, over 15 years with MO Group. He's to head the research at MOSL. Moved to AMC. He's managing our mid to mega strategy. Vaibhav Agarwal is he's a promoter, right? So he's Ramdev
Promoter.
again, but professionally he's done very well. All the strategies he's managing, he's demonstrated turnaround and sustaining the performance. So there we got Abhishek Anand from outside Central PMS, but largely if you see, out of eight fund managers, six are on
Are
board
all grown within the organization.
with
Amazing.
over a decade of experience. So that those are the people level changes, right?
Correct.
All these guys are young guys. They came with tremendous energy. Everybody had seen the pushback and all the critics and everything. So everybody was really charged up that we have to demonstrate. So that energy was really very, very good. To support them, we started to create our very strong analyst team. So we created analysts to understand the chemicals, the metals, the powers, the digital businesses, because you need that kind of a understanding when you have to get into that particular sector, right? So we started to strengthen the investment team. From just to summarize, from 12 people, we are now 30-member team.
30.
30, and we should be more like 35 to 40 member team maybe in the next 12 months or so. So a lot of because eventually investment team is like a engine in the car, right?
Absolutely.
Honda is known for engine and less for the car per se. So we want to be known as investment experts, or we want to known for our investment.
No, no, as
Uh,
I in the beginning only I mentioned that you are unapologetic that you are only going to manage one asset class, which is equity, and
yes,
that's your
yes.
expertise.
Yes, within that we are creating a lot of differentiation.
Yes,
So
yes, of
we
course.
will talk about it. The second thing was on the QGLP, which is the process which remains same: quality, growth, longevity, price. The only thing is that from high quality, we said that we'll focus on high quality and high growth. So so we started chasing. earnings growth with the underlying belief that eventually the performance of a business is directly correlated with the performance of their profitability growth. So we started chasing growth, and we started then creating or started to identify themes. Again, we'll talk a little bit in detail later on. But how to chase growth, how to get growth, we identified themes, sub themes, and then stocks. So that's how the portfolio started to change. We did a lot of work on the third side, which is the risk management policies. So, basically remain focused investors up to 35 stocks, so that doesn't change. But within that, spread your allocations as far as possible. Try to flatten out the portfolio 4 to 6% weight per stock. Don't over allocate in businesses, don't under allocate in the businesses. Conviction should be seen in the portfolio without taking too much risk at the top end. And then obviously, like you mentioned, we have our own processes to identify where we need to cut our, or we need to book our profits, where we need to cut our laggards.
Earlier,
So
you were just holding on to your
yeah,
multi-barrel, but now you will start booking some profits at a higher valuations also.
we have understood that this is a business where you have to be on the treadmill all the time. It's a machine which is on 24
Because
bar 7.
cycles are becoming much shorter, Akhil. So you need to be really on top of it at every
Yes.
point in time.
So now if you see our portfolios, and a lot of people obviously comment also, I mean, between 2014 and 19, our churn ratio used to be 10-15%. Nothing used to change much. But today it's like
So from
50%.
bottom up, now you come down to top down also. Earlier,
Yeah,
you always used to be.
yeah. Because when you talk about identifying themes, then you're doing some top-down thinking as well. But
Correct.
I would say I would say 60-40. 40% is top down, 60% is bottom up. Because after doing top down, what to buy is more
Well,
important.
yeah, of course, of course.
And then getting that right is even more
How
important.
much flexibility do you give your fund managers now? Because you are already set things in place after some mistakes which were there. You introspected. You got an investment committee. You have a new fund management team, etc. How much within this guidelines? How much do you give leeway to the fund manager?
So broadly, 65% of the portfolio has to represent the house common themes. So
Right.
that's like a must. So non-compromisable. There is a 25% flexibility given to the managers to go outside the house common themes, basis their understanding, basis their outlook on a certain sector or a business. So that flexibility of 25% is available to them. Another 10% has been kept for risk mitigation. Now, when we talk about risk mitigation, is basically because we are aligned to the index, we have to see what's working in the index at all points of time. And if at all there is a scenario where a company like Reliance Industries, if it really is tailwinded and it doesn't fit in your process, then just because it's there as part of the index, we need to have some allocation out there to ensure that that part is taken care of, underperformance.
So you will definitely be part of the, you will have some index representations also at the higher end of
Yes,
the
yes,
weightage.
yes, yes. You have to. I mean, our active ratios are still very, very high, but you still have to. We have to beat the index, so we have to have an eye on the index also.
You had not invested in Reliance earlier, but you started investing in Reliance now post your jig of the entire
Yeah,
processes.
we are into Reliance through Geo Financial, so we don't have
Okay.
Reliance Industries. But I mean, let's say just to give you example, HDFC Bank is a big name in the index, right? They've been going through a phase of underperformance. uh, you know, and as a typical cycle, there could be a mean reversion and they'll come back someday, right? And they are a big weight. Right now, we are under allocated or zero allocated, but you may want to then, once HDFC starts to come back, you may want to have some allocation, right? To ensure that you participate in that upside. See,
Correct.
eventually, how do you outperform is that how many of your stocks are winners, how many of your stocks are actually outperforming the benchmark, how many are underperforming. So more stocks you have which outperform the benchmark is the only way you can outperform the benchmark on longer term basis. So
Correct.
so one is your core belief, your core understanding, your core philosophy, and then you put some small 10% kind of a freedom, that if the manager wants, there should be no excuse for underperforming. So you have this risk mitigation window also available.
So, Akhil, all this has really panned out Amazingly well, because all of a sudden, if you see from in the flexi cap category, the mid cap category, the large and mid cap now, the large cap, these are the new funds, of course. But if you see the old funds, which is the mid cap and the flexi cap, they are number one, number two performers. All of a sudden, after all these things are put in place. So this is the bounce back story which we were talking about. Uh, so you must be very happy now. I'm sure it's you're again back to the first recall kind of a situation where if you have to allocate some funds to a large and mid cap, Motilal Oswal large and mid cap will come as a first recall, and of course in the other categories also. So how do you how do you feel and how does your team feel about this?
No, it's encouraging. I think I can see a lot of happiness amongst our distribution partners. It's very encouraging that investors are coming back to us once again. I think it gives us more satisfaction to see how the distribution fraternity is reacting, and they are willing to work once again, and it's happening. I can see that in our numbers. There is still there are still some pockets where there is a kind of a wait and watch on us. But
Like
I'm sure as we continue to perform, I'm sure those.
because I think you are there in practically in all the segments you are there in the top quartile. So which is the segment which I've missed out on?
No, 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 not on the segment side. Some parts of the distribution community who's still thinking or
Oh, okay, okay.
who still
They are
put
still
us
doing
on.
wait and watch. So
They're
whether this
still
is going to
they're
continue
still
or not.
so waiting eagerly waiting for them also to join the party.
They will lose out, unfortunately. That's all I can say. Tell me, when most of the fund houses are 60 to 70 stocks, you still continue to be of the belief that concentration, less number of stocks, it can work either ways, right? So if you are concentrating on the number of stocks to be not more than 30, which is practically in all your schemes and your AIFs also, how do you ensure that when the downturn happens or the bear market happens or the corrections happen, you're not badly affected or the investors don't lose out too much because of the concentration?
So, like I said, we for now we have an outer limit of 35 stocks, but we will try to avoid any kind of a surprise in case of a correction by not having businesses which are over allocated into the portfolios. Now you just go back in time. You can just keep comparing what was happening between 2000 between well, before 2018. The top 10 stocks used to be like 70-80% of the portfolio. Today the top 10 stocks are well below 50% of the portfolio. So like I
Wow.
said, we need to have 35 stocks, but if you are giving 4-5% weight to each stock, multiply by 30
It's more
35
like an
stocks.
equated kind of a portfolio, but with 35%, 35
Right.
stocks,
Yeah.
not.
Exactly. So we are just you look at our portfolios, barring one or two names which where there could be a passive breach. I mean, there are internal processes like beyond 7.5% weight, the system will not take fresh orders. So you cannot buy incrementally new shares once your weight is crossed 7.5%. That's the first step of risk mitigation.
Right.
Second step is beyond 9%, then there is a flag and you start to take your profits and come down, which we are doing quite actively if you see across our portfolios.
Now let's talk about the corporate milestones. They are amazing milestones which you have touched on. So we'll take one by one. The first one is your 95,000 crore AUM AMC now. 70,000 crores out of that is active funds and 24,000 crores is a passive funds segment. So that's a phenomenal breakup of active and also passive at the same time. So have you crossed the 1 lakh crore mark?
So we are, as of yesterday, we are exactly 1,300 crores away from a lakh crore. Maybe next call in next week should be a lakh crore call. So
Wow,
hopefully
all the
this
best for
market
that. I'm sure
good.
it'll happen sooner than later.
But this 1 lakh obviously was a magical number, right? Right. Since 2013, we have been always dreaming about reaching a lakh crore.
No,
Obviously, now
वो
the
तो है,
dreams
but Ramdev ji has also been speaking about the census being a lakh very
lakh
shortly,
16.
very soon.
So now lakh has taken some time. Now the targets are very different. So we need to make this 5 lakh.
Now
But
you
yes,
already achieved that 1 lakh crore AUM, so to say.
yeah,
So
yeah.
what is your next target for your team?
I mean, yeah, we are discussing, but obviously, I mean, you want to see. I mean, immediately we would look at 2 lakh, and then the longer term target for 2030 is more like 5 lakh crores, right? So it's a moving number. So if markets do continue to do well and everything is good, obviously you reach your numbers much faster. But what I want to share is that yes, for 4 years we were languishing between 45,000 crores of AUM between 2019 and 2023, and we saw a bottom AUM of 27,000 crores in COVID, 2020. Right.
Wow.
So 27 was the bottom in last 5 years, and 40,000 was more like average AUM over last couple of years. 1.5 years as the tide changed and the performances come back. Obviously, the performance also supports you, but getting distributors back, getting investors back, and that is where you see the second milestone. I think from net negative sales, we are now net positive sales
The
across.
gross sales are almost 15,500 crores
Yeah, gross sales for
and
the.
81% AUM growth, ending July 2024.
That's
It's
right. So
amazing. And net sales is monthly run rate of 3,000 crore plus.
absolutely, absolutely. So a lot of milestones. I was very happy. I mean, okay, gross, net, all that stuff is fine. Net sales makes me a lot more happy because that is incremental growth for the firm. Happy that we are sharing. I mean, market is also doing its bit, but we are also doing our bit, right? So that is one thing which gives a lot of happiness. I think the other happiness I really got was crossing the 500 crores of SIP book last month. So as on 31st July, we were just about 115 crores 2 years back. From there,
SIP
500,
book.
and I'm talking about net realized book. I'm not talking about registrations. Registrations would
Correct,
be well
correct.
over 1,000 crores. This is all the cash I'm receiving. So a lot of the year-end targets are broadly done in the first 5 months. So everything will change now. But yeah, I can thank all of you and all the distribution partners and all the investors for the support.
Now tell me, you come up with, you're not a fund house known for coming out with NFOs one after the other. And you're not an asset gatherer, which I've maintained also. And I believed also when I was doing interviews of your fund managers also for different small cap, multi cap, defense fund, etc., etc. I've been on record saying that you're not coming out with NFO for the sake of gathering assets. You're coming out with the NFO because there is a story behind that NFO.
Right.
So
Right.
you have anything to say about this 12 NFOs or 13 NFOs which you come up
Because
with last 1.5 years?
so I mean,
Why the change in stance?
no, there was no change in stance. There were there was a plan that at the right point of time we will try to address different segments which we were missing out on. We feel that we can add value across the categories of mutual funds, but launching mutual new fund offers when the cycle is not in your favor generally will have a not a great impact on the fundraise, right? So it's like if you're doing a fundraise, it has to be a good fundraise. So Ramdoji always said that deserve before you desire. So any new launches should only happen once your existing funds are doing well. And on the backdrop of good performance, obviously, you can have better fundraisers. So
Sure.
then, over the last 6 months, we started to first complete our different market cap buckets. So we completed the small cap, the large cap, the multi cap buckets.
Multi-cap.
Multi-cap. So this completes my market cap buckets. Now, as I said that one way we are trying to do our investing is by identifying the right themes. Right, we have 7 themes right now where we feel the earnings growth momentum could be very
So
strong.
let's talk about the themes. Just give me
Yeah,
a second. Some of the key themes which are potential leaders in the current Capex cycle: electronics manufacturing, China plus one, make in India, defense, power and energy, auto and auto ancillaries, and capital goods. And
yeah,
this, I think they are matching very beautifully with your in-house themes also. Am I right in saying that?
absolutely. Now you see the first thematic fund we did was a manufacturing fund last month. Now you see my existing portfolios. Minimum 35% to maximum 65% is all exposed towards manufacturing sector. We are very, very excited about manufacturing as an opportunity over the next 5 years. I'm not getting into the specifics about why and all that stuff, but in general, you have covered this.
Yeah.
So when we are giving such high exposures to a certain theme in our existing portfolios, we thought that why not play this theme individually? And then investors and distributors who believe in this theme for that additional alpha can actually
And these
put
are
some.
not short-term, seasonal themes which are going to become a flavor of the season, so to say. This
Manufacturing,
manufacturing
you
theme
know,
will
Sunil,
definitely
if
continue to.
if India has to do a 6-7% of GDP growth, manufacturing has to contribute. We all know that.
Absolutely
If we
correct.
don't scale up on manufacturing, then sustaining this growth is also going to be very difficult. If we have to get employment back, we need to get more factories and more employment. So the government is quite focused that way to ensure that there is a make in India. To have better make in India, you have a PLI scheme. They are very conscious that how we can take advantage of the China plus one, so how India can be the alternate supply chain. Right now, to get good factories working out here, you need to be energy efficient. So to support that, you need a strong energy kind of a infrastructure platform. So you see a lot of focus on the renewals over the fossil fuel. So it's all connected. Now if you see, manufacturing is a very broad based theme. If you see the Nifty 500 companies, over 250 companies are manufacturing companies. Anything from consumer durable to pharmaceutical to defense to power to cables, everything is manufacturing. So
Correct.
you just do minus digital and minus bank, everything is manufacturing. So it looks like a thematic or a sectoral opportunity, but it's actually a very diversified theme. So that's the first theme we have done because we believe in that, and that belief is reflecting in my existing portfolios all across. Number one.
So those are your in-house themes. So naturally,
Yeah.
since you have the expertise of identifying and putting it across all your schemes, you may as well come up with a separate scheme also.
Yes. And as I'm talking to you, we have two more themes already ready. We have to see when we should, and I'm talking on the active side. So the other opportunity we are really excited is on the digital side. Now, digital minus IT. Okay,
Okay.
so all the businesses which are tech-led businesses, just like businesses you are seeing on the Nasdaq, right? I mean,
Right.
essentially they are consumer businesses but driven technologically, which is also happening in India. Enough opportunities are there, and that could be really high growth over a longer term phase. So that's one opportunity. At some point down the line, we will launch. Innovation is another opportunity where we are looking at. So we have some house beliefs. Including infrastructure, by the way. So there will be some thematic opportunities where we are comfortable, confident of creating a reasonably good portfolio.
Now let's talk about the macro Goldilocks period, which is for India currently. One is the current account deficit, which is almost under control. And in fact, last quarter of FY24, we were surplus. That's
Yeah.
number one. The fiscal deficit this year in the budget, they are in the fiscal consolidation path. In fact, they went down to 4.9% instead of 5.1%, which was announced in February vote on account, and going down to 4.5%. That's another huge positive. The interest rates, which are almost peaking, and I'm sure RBI will follow interest rate cuts also, post Fed cutting interest rates also. So that's another positive. So and the PMI, which is also, and the healthy balance sheets of corporates, banks, etc. So these are all amazing, macro factors as far as India is concerned. But on the valuation front, mid caps, small caps have really run up. Large caps may not be as much as the mid cap and the small caps. So where do you see actual value, and what should the investors be worried about at the current juncture in the market?
No, so clearly valuations are quite ahead of now the fundamentals, especially in the mid caps, on the small caps. It's a no-brainer. Everybody knows about it, but it still continues to do well so far. From investors' perspective, when you can clearly see that there are some spots where there is a you need to be cautious, or there could be some froth. Obviously, you have to stay away or be under allocated to those spaces. So I would suggest that incrementally, if one wants to book profits in these spaces and move towards larger cap funds, or move towards flexi cap funds or multi cap funds where there is a good mix of large, mid, small, will always help to reduce the risk in the portfolio, overall client's portfolio. This is a time where you cannot be away from large caps. Honestly, there is a lot of margin of safety in the on the large cap front. It may underperform mid and small for maybe couple of weeks, couple of months, but as they say that you can leave that the icing for somebody else, right? You need to somewhere come out and readjust your portfolio. So I'm saying that be in equities, there's no debate that Indian equities will not do well. But from time to time, you need to shuffle. I think 2022 was a great time to shuffle from large caps into mid and small, and those who did made a lot of money. And today is a time where you need to have a good mix of large, mid, and small, depending on your appetite, your risk, your comfort level, etc.
Do the
So
investors be worried about the capital gains tax issue also when we are doing this reshuffling?
yeah, I mean,
Because there is a tax implication, right? Every time when we try to do this reshuffling or asset allocation.
see, first of all, the tax is on gains. So if you made gains,
I
it's
know.
okay to pay your, I mean, most of your gains would be long-term gains. So you're paying 2.5% more. That's okay.
Correct.
But again, not giving you any bearish call, but it's better to lose 10-20% of your returns. It's better to pay 2.5% extra tax, right? So I think it's a time where risk management should lead return management, I would say this way. So be conscious. If you have decided, very simplistically, if you have decided 50% equity, then remain 50% in equity. If 50 goes to 60 for some reason, at some stage bring the 60 back, to automatically you are doing your profit booking.
Yeah.
Just be active, be in the right spots, keep reshuffling your
In the
portfolio.
right bucket
Depending,
also, mid cap, small cap, large cap, right bucket also is very important.
just because large caps have given 30% CAGR for 3 years doesn't mean it will give you 30% CAGR for next 3 years. So if you have made a lot of money, you should reallocate. There's no
What about
harm.
bullion? What about bullion? Because nowadays, all of a sudden, there is a talk about gold breaking out and silver likely to do better than gold also going forward.
Yeah.
Any views? Your house views on that?
No, we don't have any house view as such, but yeah, I mean, from the commodity desk, they are giving a positive outlook on both gold and silver for the next 1 year. Certainly, one has to keep in mind that while in India, at this stage, we are not really thinking about domestic risk or local risk, but there are always risks which are outside of India, and the geopolitical tensions which are there. And if something sparks, then if there is some kind of a calamity, then gold will come to the rescue, right? So I
So
feel
then why
that
not be proactive instead of reactive and convert at least 10% of our
100%,
portfolio, client
100%,
portfolios into a
100%, I agree with you.
and make that as a core portfolio and just sit on it because that's a portfolio which is going to come as a hedge against inflation, hedge against these uncertainties, etc. Also.
Not only, I mean, I would say you can look up to 20%. So in our multi-asset fund, we are contemplating to increase our gold allocation from 10% to 15, 18%. That's the job of the multi-asset fund to do. So I
Sure.
would say up to 20%, depending on your outlook for next 1 year and your perception of risk. I think, there was a time we used to say stay away from gold. Now we are saying that I think gold should be a permanent allocation between 10 and
Even I
20%.
used to say that
All
gold
of
is
us, all of
not
us,
an
but
investment; it's just an allocation.
personally, in my mind, I'm trying to rework my allocation. I've not been able to press the button, but I think but most of our wives would be doing it. So keeping that on the
No,
side.
but unfortunately, that's never gets considered in the investment basket.
Absolutely.
So, your parting thoughts: will you be able to take this journey forward in the similar manner? And what kind of comfort can you give to the investors and the distributors?
I would just like to conclude this talk by saying that we've had some immense learnings in the recent past, very, very recent past. It's not been a long time. We've learned a lot. We've taken the feedback with in the right stride. We have worked towards the feedback, and we've kept the common goal to perform and perform consistently. We are going to be aligned in terms of relative returns, and we will do everything possible to ensure that we can give a smooth experience to investors over very, very long periods of time. I can see that confidence and that commitment and the conviction in our investment team as I deal with them. That gives me a lot of confidence to speak confidently to all of you, giving this kind of a comfort that don't think much. We are well aligned to what you expect out of us, and take a leap of faith. We have a variety of products. Pick and choose whichever you like, and we'll ensure that we do a reasonably good job.
So, if somebody had to do their own asset allocation versus selecting some of your schemes, would you recommend flexi cap or a multi cap?
my strong call is on our own FlexiCap fund. And if you see our FlexiCap fund, it is a fund which is going through a huge amount of turnaround on the positive side. We are very hopeful that in the next 3 or 4 quarters, we should take away this underperformance, minor underperformance. Let me put this way. It's only 0.7% on 3 years and about 2% on 5 years.
Based on the benchmark.
Base is the benchmark. So we should overcome that. And then your 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, just like some of our other products. So this product, which it makes immense sense today because one, we have the manager advantage. Niket Shah, who's done a great job on mid-cap fund, is managing the flexi-cap fund. The overlap between mid-cap fund and the flexi-cap fund is 60%. Right. So broadly, you are getting the same names, same high conviction names which are there in mid cap in flexi cap. But given current juncture we are, the exposure is literally half. So the mid cap in our flexi cap fund is under 40%. And the large cap is over 50% and a very small exposure to small caps. So it's a fund which is rightly allocated towards mid, large, and small. As I said, you have the manager advantage. You are seeing the turnaround in terms of your 1 year, 2 year rankings and returns. And I always say that when you see a fund which is turning around, is the time you have to enter, because if you really want to experience the turnaround journey is where you make the delta also. Right.
Sure.
So I'm giving a very, very strong call in the current market itself. Flexi makes a lot of sense. Within that, Motilal Oswal Flexi Cap makes immense sense. And always keep in mind that we are the largest investors of our own Flexi Cap fund. So on 12,000
The
crores,
promoter money.
3,000 crores is our own money, which has not left us, which is
Okay.
there since 2014 till today.
Awesome. Now, my parting thoughts to you, Akhil, is that, one is that we decide instead of us doing asset allocation on our own, large cap, say mid cap, jao, mid cap, say large cap, jao, small cap, etc. Let's assume select your flexi cap. But your mandate as a fund manager is to be 100% in equity. But at some points in time, the valuations may become expensive. Would you not take cash calls in such situations and protect our downside so that I don't need to get out of your flexi cap kind of a product wherever
Yeah.
the markets are overvalued, and then you protect me on the downside?
Yeah, so we are not strong believers of taking cash calls. It has backfired in our case also. But recently, at least Niket did take some cash call, meaning that he sold off, he took profits of some of the businesses. He's reallocating. So we built reasonably double-digit cash in our mid-cap flexi, and he's done some. He's put some contrarian sectoral allocation. So if you see our mid-cap IT has gone up to 20%, somewhere around that,
Which
right?
is the
So
mid cap IT, the mid
it's
cap
where
segment of IP, not the
also
long.
it's a very
No,
contra kind of a call. We
correct.
have sold some of the expensive names and we have reallocated to an opportunity which presents some value over the next 2 3 quarters. So that we are doing that, and specifically in the mid cap we are doing it.
My only suggestion is just mull it over internally, because if you can actually take active cash calls at some point, when the markets become euphoric, you will come to know yourself as a fund house, because you are too glued onto the market,
Yeah.
including the FII flows, etc., for you to take that call. So that will really help the investors and the distributors
So I
both.
can tell you that our mid-cap managers, they have to be more conscious and more cautious. So if you
Sure.
see on our alternate, Rakesh Tarve from time to time has taken cash call. Niket, he's done several times actually in the last. Right, so he's very fund managers, fund manager, how he thinks, what is his thought. I mean, if you're getting money, constant flow of money, and at the same time you've, let's say, done some trimming of your portfolio, and if the opportunity is not there, then it's better to be on the cash. So cash call, maybe not the right thing, but we will just not put money anywhere and everywhere without putting our head. So if
Yeah,
there's
yeah, I'm sure. I'm
opportunity,
sure.
holding cash will be there. We are doing that, but I'll take your feedback.
Perfect. Thank you so much, Akhil. It is always a pleasure to speak with you and your AMC fund managers whenever I get the opportunity. And thanks for giving us the opportunity of interviewing you and your fund managers also.
Thank you, Sunil. Always good talking to you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.